Hi, and welcome to a rainy Monday edition of Coffee with Brendan. Today, we're going to talk about recessions. That has been a common topic that some of my clients have been asking me about, but also we hear it in the news. And what today's video will be is to discuss why are we talking about this. It seems like it's been definitely a bigger topic of conversation just in the last few weeks. And how does it impact you? So let's just jump right on in and try to explain why this conversation is starting to pop up. It all comes down to inflation. I know that is a word that not too many people want to hear about these days because it seems like everywhere you turn, the price of everything is that much more expensive. So inflation is not a fun topic to talk about, but that is pretty much where we have to start when we talk about recessions. So why do we have this inflation issue right now? And the answer is that there's a gigantic imbalance between the demand for goods, which is way high, and the supply of goods, which is very low right now. And why is the demand for good, or why is the supply of goods very low right now? The answer is a lot of this kind of dovetails in with COVID. Right now, China, which supplies many of our goods, has been operating at a fraction of its typical production. And so things like refrigerators, things like name anything. A lot of stuff comes from China, and the supply of that is very low right now. However, the demand for those goods are very high. Similarly, we look at gas, and I'm going to try desperately during this video not to walk into any minefields here of political discussion, but one of the big reasons why gas prices are so high right now is that Russia invaded Ukraine. And when Russia invades Ukraine and the world, for all intents and purposes, boycotts 10% of the world's oil supply, that means the other 90% of oil that's out there is in much higher demand. And so the oil producers know that. The people that make refrigerators know that. The people that make cars know that if you have a high demand for stuff and a low supply of stuff, there may be 5 buyers for every 1 unit of whatever you're selling. And so therefore, if the first person or even the first couple people don't buy your good, you go to the second, third, and fourth person to buy your good at whatever price you're willing to charge them. And that's one of the main issues that's going on right now, is that there's this gigantic disconnect between supply of goods and demand for goods and supply of goods. So how does that relate to the concept of recession? Well, there's only 2 real ways to combat inflation. One is we have to bring this back together, more closely together. So you can increase the supply of goods, which again, we don't have that much control over. We can't tell Putin to get out of Ukraine so we can buy his oil again, or have the rest of the world buy his oil. We don't buy that much oil from Russia. Again, another thing, and again, trying not to wander into political things, but when the supply of oil in the United States could be increased, based on some of the programs and some of the things that the current administration has done. I'm going to leave it at that. The impact of that is very debatable. The other piece of this is the supply from China. So again, once China is done with COVID, hopefully the factories will reopen, people come back to work, and that supply of goods will come back. Think back to the whole PPE, the protective equipment like masks and gloves and all that kind of stuff. We were at a very low supply of that stuff, and so it was very expensive to get those that protective equipment. But eventually, China came back online and supplied us with all the protective gear that we wanted. Same thing with refrigerators, cars, et cetera, et cetera. So one way of addressing this is supply, but is to attack the supply. The only challenge with that right now is that our ability to impact supply is somewhat limited because it is governed by other outside of the United States countries. So what has the Fed tried to do? They've tried to, since supply is not going anywhere anytime soon, they've tried to bring down demand. Now, how do you bring down demand? You raise interest rates. So a couple of weeks ago, they raised interest rates by 0.75%. What does that ultimately do? What that does is it reduces the number of houses that are purchased, and there's a ripple effect from that. If people are not buying houses as much because mortgage rates are so much higher, then they don't go to Home Depot. They don't hire contractors. They don't. So there's this ripple effect that when people stop buying houses or curtail their buying of houses, other industries and other places of employment are impacted. Car loans, same thing. Credit cards, same thing. What they're trying to do is ultimately try to drive down demand and make it more onerous to buy stuff. Now, eventually that will probably impact things. And frankly, a lot of times the Fed in its history has they call it tightening. They've increased interest rates so much that it becomes so onerous that people don't buy stuff anymore. There is a double-edged sword to that, however, and this is where the recession conversation starts coming in. If we look at what makes up our economy, what makes up our economy is right here. 68% of the economy is driven by consumption. So when you have this overactive Fed that's reducing consumption, reducing demand, what ultimately happens to the economy? The economy starts contracting. And when the economy starts contracting, that's when the concept of recession comes in. And so, what everyone wants to know is, what is a recession? What is the definition of recession? The definition of recession is right here. It's pretty much a significant decline in economic activity that lasts for months or even years. And what happens during a recession? Well, if there's a smaller demand for goods, then guess what? When there's a smaller demand for goods, I always like to use the idea of Apple or the example of Apple. So let's say people are not buying as many iPhones anymore. What does that mean to Apple? Well, profitability probably comes down. And what does Apple typically do when the profitability of Apple comes down? Well, number one, their share price goes down, so the stock market typically gets hurt. But then also, they may start laying people off. They may start laying people off at Apple stores. They may start closing Apple stores. So there's this, again, snowball effect that happens when consumption starts declining and people stop buying your goods. And so, again, all these things kind of play into a recession. So ultimately, this is a good list of things that could happen. You could lose your job. That's probably the biggest thing and the biggest concern that most people have when it comes to a recession, is that they could lose their job, because a lot of people's financial futures are based on their ability to bring in income on a recurring basis. They can't save money into their 401k. They can't invest if they can't buy houses. All of those things are consequences to someone losing their job. But then, as we talked about, the stock market tends to go down. Business owners tend to, go out of business. So some of the weaker businesses go out of business. If you can't pay your bills, then, lenders like banks, they stop lending. So long story short, lots of different bad things can happen during the recession. But a key thing to remember is that recessions are natural. This is the business cycle. There are expansions, and then there are contractions and recessions. Now, what we don't want is a depression, but that's typically when there's something much more sick with the economy if there's a depression. That typically lasts for years as opposed to several months. So everyone always asks me the same question. Okay, let's say that we're in a recession. What does that mean to my portfolio? So let's take a look at that. So historically speaking, when it comes to a recession, this is what you should expect, is that historically, I like to use median. So the median of rates of return of a portfolio are negative 24%. During the worst of this market, which happened right around the time the Fed dropped its interest rates in June of 2022, the market was down right around this 24% number. But then look what happens a year later and 2 years later. Again, median, and this is historic, so no promises here. But historically speaking, the market bounces back pretty dramatically 1 and 2 years out. And why is that? Why does a market bounce back pretty consistently? Well, if you think about it, it actually kind of makes sense. Like, let's go back to our example with Apple. So Apple starts shutting down stores, starts laying off people, et cetera, et cetera. Well, guess what? They're making some changes to their business that are probably good changes that they should have made while they were expanding. But, at the end of the day, they weren't making these hard decisions, like shutting down stores that are not as profitable as other stores, laying off people that aren't as productive as other people. So there's a pruning that happens, and just like when you're in your garden and you prune back some I hate to refer to people as dead wood, but when you think about it, that's what you do when you're pruning. You get rid of some of the parts of the plant that aren't performing as well, so that you can let other ones do a lot better. And this is the thing. Recessions are natural. And while you're in the middle of the recession, it's not so good. But on the other side of it, historically speaking, of course, you're looking at greener pastures ahead. So again, no promises here. I can't predict what's actually going to happen. We may not even go into a recession. That's what's called a soft landing. That the Fed is able to reduce demand but not trigger recession. That's what everyone's hoping for, but I'll tell you, more and more economists are actually casting some doubt on their ability to coordinate that type of soft landing. So there you go. There's recession in a nutshell there. Hopefully, I've answered some of the questions that you may have. Recession's bad while you're going through it, not so bad coming out of it, and typically the market has, historically speaking, recovered from it. So hope you have a nice week, and I hope this was helpful, and I look forward to our next conversation. Bye-bye.